So this is the syllabus that you are going to be tested on. So between now and the date that you are writing your exams, please make sure that this document becomes your Bible, so that whatever you are learning, you make sure that it's within this area. The first one is the question 1, which is business combination. No matter whatever the situation is, you will be tested on question 1. And question 1 is about business combination. So the examiner is expecting you to explain and apply some appropriate accounting and financial reporting standard in 1, the preparation of financial statements for a group of companies. The examiner would want you to have a fair understanding when we say separate financial statements. And the examiner would want you to understand what is meant by investment in an associate and a joint venture. And take note, the second point is about theory, investment in associate and joint venture. So you can be asked what is meant by joint venture, what is meant by joint operation, and joint arrangement. These things are low-hanging marks. But you can also be tested on practical questions on joint venture. So take note. Business combination with respect to IFRS 3, IFRS 10, IAS 27, you will be tested on that. And then the consolidated financial statement preparation itself, then joint arrangement. As part of question 1, you will still, colleagues, be asked to explain some of the technologies in business combination, the methods of accounting for business combination, including investment in associates and subsidiaries as well as joint venture. Colleagues, that is still not enough for question 1. You must be able to understand how we identify intangible assets when they are acquired. And I will take you through some of these things. When intangible assets are acquired at the time of consolidation, where the examiner will tell you that, colleagues, included in the acquisition at the time of the subsidiary and the joint venture, the associates, all the assets were the same, or they had the same carrying amount, except an item called brand, except an item called patent, copyright, that had not been included. And we would have to understand how we treat that. You must also have a fair idea about what we mean by fair value and other adjustments and related issues. Colleagues, that is the question 1. As part of the question 1, you must be able to understand what is meant by control. You must be able to understand what is meant by pre-acquisition and post-acquisition. We mean by non-controlling interest, how we determine goodwill, the full method, and then the proportionate approach, and then the treatment of intra-group transactions concerning a parent selling to the subsidiary selling to the parent, where there have been dividend payments, where there have been transfer of assets. These are the intra-group transactions. The examiner would test you on it. Then we would have the computation of your goodwill and the impairment. The examiner will tell you that the goodwill that you have computed, it has been subject to impairment. How do you treat it? Colleagues, still on question 1, the examiner will ask you issues of significant influence. When is control set to be established? When do we have significant influence? if the examiner wants to go back, he can ask you the justification between the significant influence in terms of the company's acts. So these are low-hanging marks that you should be able to look at. And then, so these are the things you need to know under question 1. And today, as part of the intervention, I intend to delve into question 1 properly. Then, when we look at the question 2, colleagues, so let me write here. In all, we have, sorry, where's my pen? In all, we have question 1, we have question 2, question 3, question 4, and question 5. The pass mark is 50. So know where your strength is. Because for accounting, the way you start determines how you can score the marks. So your pass mark can come from any of these questions. You know that question 1, which we have just gone through, is consolidation. And I've just mentioned the things that you need to know under consolidation. Now, colleagues, look on the screen. You see what you'll be tested on in question 2. These are the things that, based on the syllabus, the examiner will test you on question 2. Question 2, what is it about? Question 2 is about the IAS and the IFRS. So when the examiner they are setting the questions, it must be within this scope. Colleagues, look at it. In all, we have about 23 of the IAS and the IFRS. How many? 1, 2, 3, 4, 5, 6. 6 by 4, that is 24. Plus 2, that is 26. So between now and the time you are writing the exam, you are expected to have a fair idea about 26 of these standards. What are they? We have the IAS 1, which is presentation of financial statements, and it's going to be changed to IFRS 18. But for your syllabus sake, you must know what the IAS 1 is with respect to what is meant by the presentation of financial statement, the element of the financial statement, what is meant by asset, what is meant by liabilities, what is meant by equity, the income statement, the components of the financial statement. You should be able to know them. The financial statement, the cash flow statement, the notes to the account, the financial position, state of changes in equity, all those things that go in there. The presentation, you must close your eyes and have a format of it. How do we present the income statement? Your revenue starting, your cost of sales, you get your gross profit, you move down to your distribution costs, administrative costs, down. You have your profits before operation, your finance cost, your taxation, profit before tax. You come to taxation, you come to your net profits. You move on to the statement of changes in the other comprehensive income. You should have the fair idea about it. What goes into the other comprehensive income? The things in the other comprehensive income are non-movement of cash items. So changes in exchange rate risk, hedges, revaluation, all those things, you should have a fair idea about it before you go to the exam. IAS 2, your inventory, you should be able to have a fair idea about it. IAS, so under inventory, what is meant by inventory, the FIFO-LIFO method, the valuation, how do I call it? The costing of it, the net realizable value, historical cost, all those ones, you should be able to have a fair idea about it before you go. Mind you, any of these standards, when you are learning them, you must have at the back of your mind. So let me write here, we are talking about the standards. And we are saying that we are looking at 26 of them, but you are going to be tested on only 4. In learning the standard, you must know that every standard must have definition, it must have the scope, it must have the disclosures, it must have the exclusions. So each of the standards that you are learning, what are the definition in there? What does it cover, the scope? What are the disclosures that you have to make, and what are the exclusions? IAS 8, the standard with 3 names. Accounting estimate, changes in accounting estimate and errors. Accounting policy, changes in accounting estimate and errors. You must know them because the examiner can teach you on. And normally I've seen questions in this area. Instances where a change in accounting policy can affect the account, a change in accounting estimates can affect the account, changes in accounting errors, or how do we account for account errors? So that is IAS 8. You must have a fair idea about it. There have been past questions on it. IAS 10, event after the reporting date. You must be able to have a fair idea about it. Which events are adjustable, which events are not adjustable. So these are the things that you must know under IAS 10. IFRS 15, almighty, revenue. And you cannot go into the exams without knowing anything about your IFRS 15. How do we recognize revenue? The steps, the 5-step model in revenue recognition. You know that anytime you have you go through the 5-step model, there will be instances that there could be deferred payments, and once they deferred payments, there will be unwound discount associated because you have deferred the consideration. IAS 12, income taxes. And here, you should be able to have a fair idea about what we mean by deferred tax, the temporary tax differences, that is accounting for the deferred tax. We must have a fair idea about it. IAS 16, we don't want to belabor the point, plant, property, and equipment. You must know what things go into the cost of an asset. And when you read under IAS 16, those of you who came to class, you have the various things that will make up the cost of an asset, and you should be able to have a fair idea. Examiner can test you on and give you installation cost, give you transport cost. All those things are part of the cost of the asset when you are explaining. And then in terms of the depreciation that are associated with all these. IFRS 16, leases. You should be able to have a fair idea about it. The finance lease, operating lease, the format, how do we go around it. IAS 20, government grants. You should be able to have a fair idea about it. How do you measure government grants? The 2 methods of accounting for government grants, the deferred method and then the capital asset approach. What is meant by government grants? These are some few things you need to know under IAS 20. IAS 23, borrowing cost. How do we capitalize when we go for interest or we go for a facility that is going to be used for a long term? So we have something called qualifying assets. How do we account for those interests that are associated with borrowing for qualifying assets? That is borrowing cost, the weighted average method. How do you account for it? So that is under borrowing cost. IAS 32, that is a financial instrument, but those of you who came to class, I was not so much clear about IAS 32 because of the fact that we talk about IFRS 9. So here the examiner has rewritten here IAS 32, but you will be tested on IFRS 9. Yeah, this IFRS 9. So the types of financial instruments, we are looking at the financial instrument measured at fair value through other comprehensive income, measured at amortized cost, and then measured at fair value through P&L. And then you should be able to know the testing criteria, the business model criteria that we use to test for it. So IAS 32 and IFRS 9 go hand in hand. IAS 33, earning per share. IAS 36, we are looking at intangible assets, accounting for intangible assets. IAS 37, provision. So these are the things that you must have a fair idea about as you go into the examination. Now, so we write here about 75% calculation and financial statement extract. So what it means is that these are going to be short questions, and we are going to test you on your understanding of this standard. at least 4 of the following standards for 20 marks. All right. Then we move on to question 3. And for question 3, colleagues, it's about once you have gone through these standards, you have gone through precisely IAS 1, which is an extension of the question 3, which is the single entity presentation. Single entity. So for the single entity, you are expected to know how to present the financial position, how to present the income statement, the changes in the state of financial, statement of changes in equity. You should be able to have a fair idea how to prepare the cash flow statement, and then the disclosures that you have to make. That is question 3 for 20 marks. Then question 4 is going to talk about the interpretation of financial statement. And here, colleagues, the key areas are the profitability ratios, the efficiency ratios, the solvency ratios, the working capital ratios, and you should be able to have a fair idea about the common size presentation and limitation of accounting ratios. Then the last area is question 5, where we are looking at the regulatory, legal, and ethical framework for the accounting profession. So mind you, here you'll be tested on what are the ethics of the accounting profession, which is a key area that the examiner normally gives. You'll be tested on the conceptual framework. So we are looking at how do we set the standards? What do we mean by, here we have even added sustainability reporting under question 5. What is meant by sustainability reporting, the ESG areas? How do we set up the standard setting process? What is the role of the IFRS, the International Financial Reporting Interpretation Committee? You should be able to have a fair idea about what is meant by the IASB. So these are the provisions in the Companies Act, and this is where they can teach you on the what are the provisions in the Companies Act concerning corporate governance. You must have a board, the audit committee, HR, the various units, and the risk committee. All these things are basically theory here. And then you have your sustainability reporting, and then the qualitative characteristics of accounting information, the element of financial statement, and all that. And then you can be tested on the concept of capital and capital maintenance. So that is that about the question 5. So colleagues, these are the things that we need to learn. So let me write here on the board. So question 4 here, we are looking at the ratio analysis. And then the question 5, we are looking at the ethics and conceptual framework. So as you prepare the exam, know that these are the things that you are going to be tested on. There could be some few emerging issues that when you don't have a fair idea about, no problem, but make sure that these areas, you can go to the examination without having an idea about these things. Right. So having taken us through what is required of us, it means that our intervention should cover these areas. And today, what I want to do is the question 1, which is the consolidation. And if we have time, we will look at the single entry or the question 2, and then the 2 we can finish up with the remaining. All right. So let me stop sharing and share my board. Oli. Okay. All right. So for question 1, the things that we need to know is that it's about consolidation, and you must know that at your level, you'll be asked to consolidate a parent, a subsidiary, and an associate. Or you'll be asked to consolidate out of a parent, a subsidiary, and another subsidiary. At your level, this is what they will ask you. So at this point, I know that you know what a parent is, you know what a subsidiary is, and you know what is an associate. At a cursory or at a glance, you know that the subsidiary is any entity that the parent has acquired more than 50%. And the associate is where the parent has between 20 to 50%. So that is that for the associate. And then you must know what the steps are in determining in preparing the consolidation. And those of you who were in class, I told you that we have about 7 steps you must follow. So you can't go to the examination room without, and you are going to answer question 1, you cannot go there without knowing the 7 processes or those steps I'm coming to list. So please, after this, always close your eyes and know that question 1, even when you have not read the question, you just do it on your paper, because those are the areas the ticks are. Yeah, let me also say this, that financial reporting, the FR, is all about ticks. So don't leave your question blank, your answer booklet blank. Let me also say this because it's part of the intervention. See, because financial reporting is all about ticks, and these things I just mentioned here, these question 1, question 2, question 3, question 4, question 5, they are related. And when you go, just calm down. They can start the question to scare you, but know that this is what it's all about. And the truth is, some of the answers are even in the questions. So you may be doing question 2 and question 3, which is single entity. You can have a fair idea about the presentation of question 3 in question 1. So if you are going to consolidate income statement, the examiner will bring revenue, cost of sales, gross profit. So you know the format. So once you see question 3, you know the format. Even the one in question 1 can help you. You are doing ratio analysis. Question 3, you can still have a fair idea about it under ratio analysis if the examiner has brought some financial statement for you to prepare the ratios. So your understanding in some of the questions here, you can know how you start your answers and based on the question that the examiner has given you. So my point is that don't be scared. All the things that you are going to do, some of them are even in the question that the examiner has set up for you. Right. So as I move on question 1, I'm saying that it's all about text. So know that for question 1, these steps we are going to go through, you must have a fair idea about it as you are going to do the exams. Right. The first one, so there's the steps in consolidation. The first one is that make sure you're able to determine the control structure. The control structure. And I'll give you a question right now as we go through this one so that we look at it. The control structure, colleagues. The control structure, you have about 4 ticks alone under the control structure. Students will not know. 4 ticks, you can get 4 ticks under control structure alone. And how do you get the ticks? The ticks is just draw the structure, give the dates of acquisition, give the dates of reporting, tell the examiner the consolidation period. So this alone, you have about 4 ticks. The total is about 50. You have gotten 4 ticks here alone. And in drawing the structure, colleagues, if it is two subsidiary, it means that you have the parents and you have the subsidiary. So that would be more than 50%. So this can be 55%, this can be 60%. If it is a parent and an associate, you can have this, you can have this. So you have the subsidiary, you have the associates. That can be 30%, that can be 60%. Immediately you draw this structure, you give the date of acquisition, you give the reporting date, and then you give the consolidation period. Then you can also talk about what the NCI portions are. So if the subsidiary has 55% here, it means that the NCI has 45%. You have to state all these ones. If the associate has, the parent has 30% here, you have to state that the others have 70%. And those 70%, that is not NCI. We call it others. That is other people who have control in the associates. We have seen students who will write the parent have 30% and NCI has 70%. You are wrong. Here you get 0. But you have to write that the other people have 70%. All right. And establishing this control, colleagues, the control can be established through 3 ways. Either the cash payments, when they pay for the cash, which will dovetail into the next area we are going to talk about the cost of investment. Share for share exchange. And then the next one is about deferred consideration. So these are the 3 ways you'll be able to establish the control. So, and this one will dovetail into what we mean by the cost of investment. So in determining this control that we have established here, the examiner can tell you that, oh, the person acquired a number of shares. So you would have to find out the ratio or the proportion of the shares. It can be share for share exchange. It can be deferred consideration. So those workings will give you the percentages you are seeing here. All right. So the first step to determine your control, which you get about 4 steps. What is here? Draw, do this in the exam. Then the second step is about your cost of investment. So step 2 is determine your cost of investment. And this is how you determine your cost of investment, either cash payment, share for share, and then the deferred consideration. Let me explain here. Share for share, the examiner will tell you that for every 2 shares, the parent is giving 1. For every 5 shares, the parent is giving 4. Then you can, this will give you the ratio, multiply by the number, the total number of shares. And then if you want to know the value, the examiner will give you the value of the share so that you can now determine the share for share value. So if the examiner want to test you on share for share, the trick you will see that the examiner will tell you for every 5 shares, the parent is going to get 3. So you put it down, and then what the parent is going to get, multiplied by the total number of shares of the subsidiary. That will give you the number of shares. And then if you want to know the value, then that will give you the price per share. You multiply it to get the value. Deferred consideration is where the examiner will tell you that, oh, the parent is acquiring the shares in the subsidiary, but he will pay in 2 years' time. So here it means that you must know the time value of money, which is your 1/1 plus r raised to the power n. So you discount it. The examiner must give you the discounting factor so that you can now multiply it and find the present value of the deferred consideration. Once you see deferred consideration, additional tick must come into your mind, and that is what we call the unwound finance cost. So you must have this idea. So that is the second step. The third step, colleague, is to determine the net asset summary. Net asset summary. So net asset summary, you must do a statement, and here you can get about 7 ticks here alone. So what goes into the net asset summary, colleagues? You must have the format that you must have the reporting dates, you must have the acquisition dates, you must have the post-acquisition position. Then here will be your narrations. So you must know what goes into this net asset summary. You must do this for the examiner. And here you can get about 7 ticks. So all the things that you have to do, even when you have not seen the question, if you know that under net asset summary, you have your stated capital, you have your retained earnings, you have your revaluation surplus, all the surpluses. This is where the trick is. You have fair valuation or fair value of items. So the examiner will tell you that, oh, included in the acquisition is a plant, property, and equipment that was not included, and the fair value of it is this. So you bring the fair value amount. Immediately you see the fair value amount, there will be depreciation. All right. And then there could be issues of unrealized profits that will come at the reporting date. So in this format, I always tell my students that at the back of your mind, A, B. So your post-acquisition period is A minus B, and that will give you your post-acquisition position. So know this format also. Then you should be able to know how to determine the goodwill. Determination of goodwill. And you know what goes into goodwill, your cost of investment, and then your net asset acquired. So you are in your goodwill computation, you are looking at how much is the cost of the business and what was the value of the asset that I am acquiring. Mind you, we don't determine goodwill on associates. This goodwill we are determining is on only the subsidiary. So don't go and worry yourself, even though you are doing consolidation and there could be an associate, the goodwill you are determining is on the subsidiary alone. So please take note. Then colleagues, you may be required to show the intra-group transactions. And in the intra-group transactions, all you need to do is debit this, credit this. That's what you write under the intra-group transactions. And any information that you see, just write it. Debit this, credit this, debit inventory, credit unrealized profit, debit consolidated retaining, credit this. That is all about intra-group transactions. So under intra-group transaction, all we are saying is that we are trying to eliminate the transactions or the monies or the profits that the group members have made among themselves. So we are eliminating them. That is intra-group transactions. Then you should be able to determine the NCI at reporting date. So how many steps have I just mentioned? Let me see. Step 1 is about the control structure. Step 2 is about the cost of investment. Step 3 is about the net asset summary. That is step 3. Step 4 is about your goodwill computation. Step 5 is about your intra-group transactions. Step 6 is about your NCI at reporting date. Step 7 is about your consolidated retained earnings. All right. So having done all these, this is where the marks are. Having done this, then you should be able to do the consolidation, which is the main question in question 1. And consolidation here will mean you are adding, they will give you the financial statements of A, B, and C. This will mean that it is three companies. And normally, the first company is about the parents. Normally. The second company will be a subsidiary, and the third one will be an associate. But the examiner can trick you. But I'm just telling you that from history, this is normally how we present it. The first one is the parent, second one is a subsidiary, third one is associate. But you can still have a parent, you can have a subsidiary, and then another subsidiary. These are the two scenarios that you can be tested on. Right. So having gone through this, let me share a question so that we use it to refresh our mind on consolidation. So let me do 2 screens. Stop sharing. All right. Then let me share. Okay. Colleagues, can you view my screen?
Yes, please.
All right. So based on what I have explained now, is there any question for me on the question 1, the consolidation? If there is no question, I can have shared a question here on the screen for us to look at, assuming we go and you see this financial statement and they are asking you to consolidate. Any question for me on consolidation? Okay. If there is no question, let's quickly go to this question and see how we can solve it for the examiner. And it is always 20 marks. All right. So read question 1. Vichy Limited has investment in 2 companies, Vichy Limited and CC Limited. The separate financial statement of the 3 entities, I think, I need to make it smaller, right? Can you view the whole question well, or let me move it here? Okay, let me lower the, okay, I'm sure it's better. Okay. So Vichy Limited has investment in 2 companies, Vichy Limited and CC Limited. The separate financial statement of the 3 entities for 2023 are as follows. Statement of profit or loss and other comprehensive income for the year ended the 1st December 2023. So look at the examiner. This is what I was telling you about question 3. You see the format the examiner has given you, it gives you a fair idea about how to answer question 3. We have revenue for Hashi, for Vichy, Hashi, and TC. We have the cost of sales, and then we have gross profit. Then we have operating expenses, we have investment income, we have net profit before tax, you have taxation, you have net profit for the period, and then you have other comprehensive income. But you know that that go into other comprehensive income, the non-movement of cash items. But here we don't even have any item here. Then the examiner moves ahead and gives you statement of financial position and says that the state of financial position at December 2023 is as follows. We have assets. Under assets, we have non-current assets, property, plant, and equipment, and you have this amount, they are there. Investment in shares, you have 41,000. Then you have current assets. So you see the investment in shares here. You have only, this one gives you a fair idea about who the parent is, because this alone can be very confusing. Investment in shares. Then you have inventory. You know, inventory, that is when we do the standard, IAS 2. Then we have trade and other receivables. We have cash and cash equivalent. Then we have your total asset. Then you come to equity. We have ordinary shares issued at 1 Ghana cedi. So we have 356,000 for the parent or for Vichy, and Hashi is nothing, and then we have 25,000. Ordinary shares issued 0.5. You see the information here, very, very confusing. You may see it just like this, but if you don't to it to mislead you. And those of you who came to class, we explained deeply how to work about these numbers. Retained earnings, you have this amount. Trade and other payables, you have this taxation. Total equity liabilities. Now the footnote. Additional information. Vichy acquired 6,250 of the CC Limited in 2015 at a total cost of 12,000. This acquisition gives Vichy Limited significant influence over CC. At the date of acquisition, CC's Limited retained earnings had a balance of 4,300. The fair value of CC Limited assets and liabilities approximated their carrying amount. So here we don't have those issues of one has been fair valued upward and there was no thing. So they're saying that it's equal the carrying amount. Note 2. On January 1, 2023, Vichy Limited acquired 32,000 of Hashi's Limited shares at a total cost of 29,000. At the date of acquisition, Hashi's Limited retained earnings had a balance of 3,500. The fair values of the asset and liability approximated their carrying amount, except a piece of land with a carrying amount of 2,000, which had a fair value of 2,500. The fair valuation adjustment has not yet been reflected in the separate financial statement of Hashi Limited. 3. The investment income of Vichy Limited relates to dividends received from the investee entities as follows: 300, TC 200. Vichy Limited also paid interim dividend of 10,000. In 2023, Vichy Limited sold goods Vichy Limited at a markup of 20%. The goods cost Hashi Limited 1,000 and one half remained in inventory at the end of the year. Vichy Limited undertakes annual impairment reviews of goods of goodwill. An impairment of 1,500 has been identified in respect of Hachi Limited for the year ended December 2023. So far, no impairment loss relating to TC is identified. The group has a policy of measuring non-controlling interest as a proportionate share of net assets of subsidiary. Required. Prepare the consolidated state of comprehensive income for Vichy Limited Group for the year ended December 2023. And two, prepare the consolidated state of financial position for Vichy Limited as of 31st December 2023. Problem of the day at work. How do you go around it? Are we together?
Yes, please.
So assuming you go in November and this is presented to you, tell me how you would start it. How do we start? Do I just start and say, oh, consolidation, question one, based on our understanding? So I see Vichy Limited, blah, blah. So 400,000 plus this one, plus this one, this one, plus this one, plus this one, this one, plus this. I finish. Is that what you do? For me. Are we together? Are we together?
Yes, sir.
So when you go, anyway, does this question scares you? No, doesn't. So because it doesn't, when you see the question, just relax. Know that this is under consolidation. Picture in your mind what are the things I have to do. When you see the question, I have to do about 7 things. And this one is about income statement consolidation and state financial position consolidation. 2 things. Normally, they can give you only one to consolidate. But in this instance, it is 2 things. So, me, Nim Shekrano, I won't leave this question blank. I don't know anything. I know control structure. Is that not it? That one I can do it. So you do in your mind, I have to do control structure. Okay, I have to do I have to draw it. I have to do the date of acquisition and the reporting date. Then I have to move on to cost of investment. And the cost of investment, it is about 3 ways. Okay. I have to do the net asset summary. I have to do intra-group transactions, NCI at reporting dates. Okay, I can start. So when you see the question and people are writing plenty, you just put yourself together and then begin to reflect on what we are doing today. All right. So, Emily, you have the question. Let's try and solve it. So, what you would do is that after reading through and you know the requirement, you go through the footnotes one by one. Okay, the footnotes that are here, go through them, and then you'll be able to discuss them. So the first one told us that Vichy acquired 6,250 of CC Limited in 2015 at a total cost of 1,000. This acquisition gives Vichy Limited significant influence over CC. Right. So they are mentioning some few technologies, significant influence. You remember, as I explained, that the examiner can ask you what is member significant influence. And normally you have significant influence when you have an associate. You have control when you have that of the subsidiary. And there are things to show that you have significant influence when you're able to control decisions at AGM. I mean, indirectly, you control their bankers. Those are the significant influence thing. All right. So let's quickly solve this. Let me bring my board here. So question 1, you see it on your answer booklet, because you are going to do, they say do consolidated income statement instead of financial position. So you write here question 1, solution. You know, the first one is about the consolidation. Leave that page blank. I always tell my students, you can't do the consolidation straight away. So leave the page blank. Second page, you can leave it blank. Third page, you can leave it blank. Either first and second or third page. Then you go to the next page and do workings. Look, I didn't tell you this. Let me also tell you this as part of the intervention information. Guys or colleagues, when we are marking, let me come here. When we are marking, we do something we call conference marking. Conference marking means that I don't pick your scripts and mark all question 1, question 2, question 3, question 4, question 5. No, we don't do that. It's a professional exams, so we know how students take the exams. So what we do is that all of us will be camped in a place. We don't mark in the house. We will be camped in a place where nobody will disturb us. ICA will pay for everything. So when we go, if I am marking question 1, it means that my job is to mark question 1 only. So when I pick your scripts, it is my job to flip through all your answer booklets, even if your answer booklet is 1,000 pages. It is my job to flip through all the 1,000 pages and make sure that wherever you have answered question 1, I have to go and mark it. Are we together?
Yes.
So my point is that don't go and be I am managing resources, I am doing this. The point is, whatever will come into your mind, write it. And you see, if you know what you are about to, you don't need plenty papers. If you know what you are about. But if you don't know what you are about, my point is, the because the examiner must mark the what you be, whatever you have written. So the question 1 like this, if you don't know anything at all and you know control structure, you have to go and do it on 17. If about him say, I have to draw, go and do it there. Don't leave anything unattended to. By so doing, that thing you are going to draw alone will give you 2 ticks. And you don't know, swap, small. Okambuma, when you have 50 marks. Aha. So, as I was saying, so my job is to mark question 1. Whatever you have done in question 2, question 3, question 4, it is none of my business as an examiner. Somebody will mark question 2. He will not even look at how you have answered question 1. His job is to mark question 2. So when he is marking, he picks your script, he will flip through all the pages wherever you have question 2. It is his job to mark. The same thing for question 3, the same thing for question 4. So the rule is one person will not mark all your questions. So you see 5 questions. How many people will mark your paper? 5 questions. How many people will mark your paper?
5.
So this one, you answered me. Now, when we start to solve the question, you have to be answering me. Good. I'm just kidding anyway. So it is that 5 people will mark your scripts. And when the 5 people finish marking your scripts, it will go through a moderator. Somebody will moderate it. It will go through a script checker. So sometimes when students say, this paper, I want to go for remarking. I'm like, really? Because the process it goes through, my brother, my sister, the winner and the winner. And even when it goes for moderation, sometimes we add some few marks to it. Those of you who came to class, I showed you how we mark it and all that. My point is that just prepare, know the areas and how you go around it. You are good to go. All right. So now let's go.
Please, a quick one. Can you please share the question with us so that we follow?
Right. We'll do. No, after it, I would. The management will share. So don't worry.
Okay.
Right. Okay. So, question one, we're saying that. So on our answer booklet, we will leave this whole thing blank. So for me, I would advise that you leave this one blank, question page 1. You know, your answer booklets are labeled. So this is page 1. Leave it blank because you come and do your consolidate. Okay, but don't leave it blank even at this point. You know that page 1, the requirement is to do the consolidated retained earnings. So you can write question 1 on your page 1. It seems that you know the name of the group already. And okay, how do I call it? Because you know the name of okay, let's leave it blank and then go and do the working before we come and do it. So page 1 for now, let's leave it blank. Page 1. Page 1, let me just write leave it blank. Page 2, you can leave it blank. Page 3, you can leave it blank. You will come back and fill that place. So you can now go to page 4. So page 4, and you call it workings. And this is where the marks are, where you'll be getting the marks. Okay. So first one is, we know that the first thing we have to do is determination of control structure. 1, determination of control structure. What goes into the control structure? We are going to draw, we are going to look at the percentage and all that. So we are told that Vichy acquired 6,250 of the CC Limited in 2015 at a total cost of 12,000. Mind you, we are consolidating in 2023, not in 2015, because the financial statement indicated that this is the financial position as of December 2023, and this is the income statement loss account as of 31st December 2023. In any event, it's 2023 that we are consolidating. So the piece we left blank, we can just write group consolidated financial position as of 31st December and group consolidated profit and loss for 31st December. All right, so we come back. The first one is saying that she acquired 6,250 of CC Limited at 2015 at a total cost of 2,000. This acquisition gives Vichy Limited significant influence over CC. At the date of acquisition, CC Limited retained earnings had a balance of 4,300. The fair values of CC assets and liabilities approximated their carrying amount. So from this, we are able to determine the number of shares that Vichy acquired in CC. So let's see. We are writing a determination control structure. Vichy acquired how much? 6,250 shares. So these 6,250 shares, the examiner didn't tell us that, oh, when we were doing the drawing, we knew it is 80%, 20%, 50%, 60%. But this information alone cannot let us know whether this is a 60% or a 30% or 20%. You know, we're able to determine whether CC is a subsidiary or an associate based on the percentage we are able to establish. So now, the number of shares acquired, 6,250. How do we determine the percentage? How do we determine the percentage? Okay, so you can determine. Yes, I'm listening.
You find the total number of shares in CC Limited. Then
Okay.
you divide the value acquired by VC over the total number times.
Good. So how do we determine the number of shares in CC? On your screen here, it's a financial position. Do we get it at the asset area? Do we get it at the asset area? This is Vichy, this is Hashi, and this is CC. Do we get the number of shares at the non-current asset area?
No.
No.
Good. So we have to, so you know, it means that you know what you are about. So where would we get it? Will we get it at the equity and liabilities area?
No, equity.
Equity. So this is the equity area. So how do we know the number of shares that are here?
So that will be 20,000 divided by 0.5.
Take note. Let's go up. The
No.
first column is for who?
Hey, sorry. Vichy.
The second column is for Hashi, and the third column is for CC. Right. So what do we see here? We see 356,000, we see 25,000.
So the third one is CC, right?
Yes.
So we are using 25,000
What does it
divided
say?
by.
Good. What is the relationship between the 25,000 you see here and the description they give here? You should be able to have a fair idea about that.
Okay, so it means that they issued some number of shares at 1 cedi, and then the total value of the issued shares is 25,000. So if you want to find the number of shares that they issue, you divide the 25,000 by 1 cedi to get the number of shares that they issued.
Super. So the trick here, colleagues, as part of the class, is that when you go in the exams, be mindful of the description. There can be some information here that can mislead you. So you must understand that the values we get here, they are based on the valuations of the shares. So that is why the examiner gave you that these shares were issued at 1 Ghana cedi. The second one, it was issued at 0.5. So on this line item, the 5,000 you see here, it was issued at 1 cedi. Here, what you see here is value, is money. But if you want, in our calculation we are coming to do here, we are not going to do money over money. We are going to do numbers. Right. So we were told that Vichy has acquired 6,250. But so at this point, write whatever comes into your mind. Feel free. So you can tell the examiner that from the question, the stated capital of CC is how much? 25,000 cedis. It not be so. But this was issued at 1 Ghana cedi. Therefore, the number of stated capital of CC will be equal to 25,000 divided by 1. And that will give us how much? 25,000 shares. It not be so?
Be so.
Right. Now that you have gotten this, you can now find the percentage, the proportion of the acquisition. You can now tell the examiner that you would have the percentage of shares acquired will be equal to 6,250 divided by the 25,000, 100%. And what do we get?
25%.
Good. Once you get 25%, what comes into your mind? based on our explanation we have had so far, if somebody has acquired 25% of the shares in another company, what is the relationship between these two companies? It means
CC
that
is an associate. CC is an
good job.
associate.
So in your mind, this one is an associate. We'll come and draw it. So you know that this is an associate. And I'm just chipping this one in. After this, go and read on IAS 24, related party. It's an area that some new examiners like. So related party is talking about control, how members in the group discuss things among themselves. So the examiner can give you some question on IAS 24 and ask you what are the disclosure requirements among members of a group, an associate, those sort of things. So IAS 24, take notes. All right. So at least we know that, where's my eraser? We know that in our mind, CC is an associate. All right. Let's move on. We are still not, all this we did is just working. We've still not determined the control properly, how we have to draw it. It's part of the working that we have to do. Right. Let's look at, so 25% is for the parent, which is the Vichy. The remaining 75%, is it, how do we call that? How do you call this?
Others.
You see, you heard somebody saying NCI. Immediately I see that and I'm marking question 1. And you told me that 75% is NCI. I mark you 0. The remaining 75% is others.
Okay.
All right. So you come back. Let's look at, so at this point, the number of Chimubia, just look at the things, pick those things, right? So we will come back, but we just want to finish up with the control structure. Did they give us any information, note 1, to give us an idea about the other company? No. All this one, we'll come back to that. But they gave us some information on note 2 that on January 1, 2023, Vichy acquired the 2,000 shares of Hashi shares at a total cost of 9,000. Oh, who is writing on my board? Oh. So what do I do now? This one, I know that it's not members who came to class. Because when I was teaching in class, nobody did this. And I don't know how to correct this. Colleagues, can somebody help?
Sir, please, the person who did it, the person is the only one who can erase it.
Adriel.
I think it's from Juliet Chidi or something.
So I'm waiting for her. Okay, I think we can manage this now. Or once she's able to clean, she should be able to help with this. Auntie Julie, can you help us with this?
Yes, please. I'm trying to clean it.
Okay, please.
Mm. Okay. I have a frozen phone.
Okay, so we will manage it. We will manage it. Okay.
Mm,
All right. So note 2 tells us that in January 2021, so here we are mindful of the date of acquisition. So we are fortunate that it was acquired on 1st January. If it is a different date, then as part of intervention, take note that if it was acquired in the middle of the year, in terms of the income statement consolidation, you will have to take note of the time of acquisition, because you will not the revenue will not have flown from the full year. So please take note. I'm mentioning some important information here, that when you go in November and they tell you that as part of the acquisition of one of the companies, one was done in the middle of the year, because this one, it was done on January 1, 2023, have you seen? And we are preparing the financial statement as at December 2023. It means that that year is starting 1st January, 1st December. So it's a full year consolidation. If we go in November and the examiner, like me, I'm bringing this question and I'm discussing with you and I want to trace it more, all I would do is that I would say that the Vichy acquired Hashi in maybe 1st July. On 1st July, Vichy acquired Hashi. It means that this revenue you see here, it is not accruing for the whole year. We have to do a 6-month period of it. So we are fortunate that we said he acquired it on January 1, 2023. You know that for state of financial position, we don't consolidate based on the proportionate period of time. It is the income statement portion, this side, that we consolidate at that time. But for the state of financial position, we consolidate full year. Note. Some students have been consolidating financial position half year, and all that. Okay. Are we together?
Yes, please.
Good. So on January 1, 2023, Vichy acquired 2,000 of the shares of Hashi at a total cost of 29,000. From this, we do the same thing that we did for this guy. So still as part of our working, just write whatever comes into your mind. Vichy acquired 32,000 of the shares. Okay, therefore, we need to know the total shares of Hashi. This will give us what? How do we get the total shares of Hashi? Do I go and see it in the revenue? Because they gave me revenue, 150,000, cost of sales. Why do I see that?
Equity.
Equity, okay. Under equity, I am here. I see the equity, I see ordinary shares issued at 1 CD, this guy, and I see ordinary shares issued at 0.5, this guy. What do I do? Knowing very well that we have Vichy here, Hachi here, and CC here.
So 20,000 divided by 0.5.
Okay. So we have 20,000 divided by 0.5. What does it give us?
40,000.
40,000. Therefore, if you want to know the percentage, it becomes what? 32,000 divided by 40,000 times 100%. You know, be so?
Yeah.
And that gives us what?
80%.
80%. So you see, instead of the examiner just telling us that, oh, Vichy acquired 25% shares in TC, and Vichy acquired 80%, so that we can just straight up do our control structure. The examiner didn't do that. The examiner is a bad examiner. He didn't do that. So we have to go through this process, determine it. So now that we know 80% and 25%, can't we draw our control structure now, the proper one that we have to do? So proper control structure now will give us, so control structure, we can have Hashi, and then we can have, okay, we can do the drawing, the one I told you. We can now have, you draw and get the marks. We can have Vichy, who is the parent, Vichy Limited, and right here, parent, is acquiring is acquiring 80%, is acquiring Hashi Limited, that is 80%, and it's acquiring 25% in CC Limited. So from here, you can say that for NCI of Hashi, it is 20%. And for other interest in CC is 75%. You write this. Then what did we say again? The date of acquisition. Date of acquisition. That is 1st January 2023. Date of acquisition of CC. That was, they didn't give us the specific date, but they said it's 2015. We just write that. Then we write date of consolidation. When are we consolidating? When are we consolidating? When are we consolidating?
31st December 2003.
You write it, 31st December 2023. But once you do this, it helps you to know, assuming we acquired Hashi in July, it will help you to know the consolidation period. That's why you have to write all these ones. All right. So you've gotten about 4 ticks here. This drawing alone. Some may not draw. Some would want to write it in a statement form. You can also write in a statement. But those of you who came to class, I do the drawing. But I don't want to confuse those class. But if you study somewhere, you can also do the statement form. But I prefer that you do the drawing. All right. The second thing we have to do is what? Cost of investment. Yes, any question? Any question? All right. The next one is we have to determine the cost of investment. Determination of cost of investment. And this one, you always have to do it. Based on the class or the discussion we have had, I said cost of investment, it can be given to you in how many forms?
3.
3 for what are they?
The cash transaction, share for share, and deferred payment.
Good job. So in your mind, in November, even if you don't do anything, write cost of determination, cost of investment, and write those 3 things there. Cash payment or cash consideration. And this determination of cost of investment is for who? This determination of cost of investment is for who? In our mind, this is for who?
Hashi. For the
Who?
parent,
Because
the
they are all
subsidiary, the subsidiary.
I like you to say it's for the subsidiary. So don't go and do cost of investment like this for associate, because the reason why we are doing this one is we want to determine the goodwill associated and all that. Because for associate, for the cost of investment, we don't determine goodwill on it. We actually find the total value of our cost of investment at the end of the year to determine the money, right? So the cost of investment we are doing here is in respect of the subsidiary. So we know that must be in forms: cash payments, share for share, and then deferred consideration. In our case, we have I don't think we have share for share. We don't have deferred consideration, but I've explained to you how this ones work. All right. So what was the cash payment that they paid for the subsidiary?
29,000.
29,000. So that one we got it from the question straight up. So just write this and underline it. You are done. You are gone. So that's the cost of investment. 9,000. All right. The next one we have to do is statement of net asset summary, right? Number 3. Statement of net assets summary. You underline it nicely for the examiner. And you know what goes into this guy.
Please, where can we locate the cash, the purchase consideration, the 29,000?
Okay, let's read note 2. Have we seen note 2?
Yes, please.
All
On
right.
January 1st, Vishi Limited acquired 32,000 of Hashi Limited shares at a total cost of 29,000. Okay.
Right. Okay. So net assets summary. We know that I give you the former 3 things. You have the reporting date. You have the acquisition date. And then you have the post-acquisition position. Or in Ghana cedis, or in Ghana cedis, or in Ghana cedis. And you know that in this net asset summary is for the who? Net asset summary you are doing here is for who?
Subsidiary.
Subsidiary.
A subsidiary. Good. But the things that go into net asset summary, so all these things should be in your mind. What are the things that go in there?
Retain
Equity.
Okay,
Equity
so we have
section over there.
the stated capital. We have what again? The retained earnings.
Retained
You have what again?
Fair valuation.
Revaluation, surplus.
Depreciation.
Before depreciation, there should be fair value adjustments. Just list them. Then you can have your depreciation.
and then unrealized profits.
And then unrealized profits. So we go and pick, all here is about ticks. All this thing you are doing is about ticks. All right. So we go and pick stated capital. How do we get the stated capital at reporting and at acquisition? Are we together? Hello?
Hello. So it's
What's the share
20,000.
capital at acquisition and at reporting?
20,000 for both.
Good job. Where do we see the 20,000? Is it in the footnote or it's where?
Ordinary shares, equity.
The ordinary. Good. That is 20,000 at reporting. How do we get it at acquisition?
The same 20,000.
So it's the same thing.
Okay. Why do we say it is the same? Accounting is always why, okay? Why do we say it's the same?
So the question didn't state that there was additional issue. So
Good.
issue as beginning will be the issue at end.
Good job. Good job. All right. So what is the difference between your mind is A, B, and this portion is A minus B. So A minus B is what?
0.
0. So the meaning of A minus B is at the time that we acquired and at the time that we are reporting, have they made any money? Because this one is post-acquisition position in terms of the post-acquisition profit. Have they made any money? Technically speaking, they do not make money on issues of shares. Right. But some of the other items, they may make money on it. All right. So let's go to the next one, the retained earnings. What was the retained earnings at the time of acquisition or at report?
At reporting is
4,500.
4,500. Where do we see that?
Retained earnings equity.
Okay, we see it here. So how do we get the retained earnings at acquisition?
So if I want to try, if it's not given to us in the question, then
Yeah,
we would have to deduct profit for the year from retained earnings.
good job. The profit for the year, how much was the profit for the year? Where do we see profit for the year?
So that would be 2,000.
Good job. So we can do that here. So we have 4,500 minus 2,000. How much do we get here?
4,003.
Oh, are you sure? The retained earnings at the end was 4,500. Right here,
2,500.
2,500. So you have 2,500. How much is the put acquisition?
2,000.
2,000. Then,
Hello, sir.
do we have, yes, boss.
Yeah, the 2,000.
Yeah.
Are we picking the net profit for the period or the total comprehensive income? You see, they are all 2,000 now. Assuming the figures are different. Which one are we picking?
It's your total comprehensive income.
That's what to pick. Okay.
Yes.
Okay.
Because the total comprehensive income details into your statement of changes in equity. So as we do question 2, goes into your statement of changes in equity are your retained earnings and the other comprehensive income. All the movements are all there. All right. Okay. What is the next item that can come in our net asset
I
summary?
think that the question also gave us retained earnings as a
In the
position. So let's look at that one.
Right. Okay, let's read our footnotes here in detail. On January 1, 2023, Vichy acquired 2,000 shares of Hashi Limited shares at a total cost of 9,000. At the date of acquisition, okay, so we're giving some information here. At the date of acquisition, Hashi's retained earnings had a balance of 8,500. We have misled the examiner. The examiner has given us the retained earnings at the date of acquisition. I think our colleague said that if that information is not given, then this is how you go around it. I think our colleague said that. You remember?
Yes, please.
Yes, please.
Together. So please, let's take notes also that when we go the exam in November, and they do not give us our retained earnings at the time of acquisition, normally they will give you the retained earnings, the stated capital, the income surplus at the time of acquisition. Normally they will give you. But if they don't give you, then the trick to do that is to determine your closing balance, and then determine the profit that you made for the year, so that you're able to determine the post-acquisition, the post-acquisition profit for it, and then the pre-acquisition profit. Let me explain. We have something we call post-acquisition profit and pre-acquisition profit. Pre-acquisition profit means that how much profit was there before we acquired the business. All right. And then post-acquisition profit means that how much profit did the group make, or did the parent make before, after acquiring the subsidiary. So no examiner will ask you to explain pre-acquisition and post-acquisition. Let me write here so that we have pre-acquisition profit, and we have post-acquisition profit. Pre-acquisition profit means that it was the profit that was there before we acquired it. And there are two ways of getting this. Either the examiner gives you the value, or the examiner, just a minute. Okay, sorry guys. I have to attend to some few things. Okay, so that is a pre-acquisition. Acquisition means the profit that the group made after the acquisition, or the parent made after the acquisition, right? So if this footnote was not given, we would have gone about it by looking at the retained earnings at the end, and then we will look at the retained earnings that the business made for the year. Then we can now strike it to get the profit that was existing, right? But in our case, we were given, so we have to use the information that we were given. So let's come back here and let's clean this guy, and let's see, come back here.
Okay, so please, one quick one. If there is an existence of dividend, and then opening retained earnings was not given the question, how do you treat that one too?
Let me write your question here. So you are asking that there is a dividend.
Yes.
Of, let's say, okay, let me just write dividend.
Dividend, and then profit for the year.
And profits for the year.
And then we are asked to calculate. The examiner didn't give us the opening retained earnings.
Like the retained earnings that was existing retained earnings.
So in this case, we have the 25,000. Sorry, the 4,500.
So profit for the year is, let's say, 4,500. No, the 4,500 here we see is the accumulated retained earnings.
Yeah.
So that is the closing balance, the
Sure.
4,500 here. So profit for the year is, let's say, 2,000. So I'm using these numbers. Profit for the year, let's say profit for the year is 2,000, and our closing retained earnings is 4,500. So let me clean this guy. So now ask your question. This is the closing retained earnings, which will be seen in the statement of financial position. And this one will be seen in the statement, the income statement. So I'm listening to your question now.
Okay.
And there was dividend. Move on.
So now you've allocated the 2,000 to the dividend. So let's give the profit 500. Profit 500.
So let me write here. Profit is 500 here.
Yeah.
And now your
Then
question is,
we are to determine the retained earning, the pre-acquisition retained earning.
okay. So when it comes to
Sir,
pre-acquisition, yes, boss.
so, yeah, so with the question, the dividend that he is suggesting, is it a pre-acquisition dividend or is it a proposed dividend? But that
Good.
also,
So somebody's asking the dividend you are talking about here. We have types of dividend. We have got final dividend. We have got interim dividend, and then we have got proposed dividend.
Okay.
So let's not complicate matters. Just say, let's say it's a dividend. It's a dividend.
Yeah.
Let's not complicate about it. I don't want to go into these areas. So let's just say there is a dividend. So ask your question now.
So now you are looking for the acquisition retained earnings.
Yes. So the pre-acquisition position is always your closing retained earnings less profit for the year, and then if there were any prior year adjustments. This gives you your pre-acquisition profit. All right. So get your pre-acquisition profit. This is your closing retained earnings. What was the profit for the year that we made relating to the period? You less that from that. And then if there is any pre-acquisition, prior year adjustment, meaning prior year adjustments are events that should have affected our retained earnings, but have not been accounted for. So that could be a dividend that has been paid that we didn't know, or they are now giving it to us. So those are prior year adjustments. Is that okay?
Yes, sir.
Right. So let's come back. Let's quickly, when I plenty, we may not even solve the question. Right. So let's come back to our question here. So we have at the date of acquisition, they give us the retained earnings. They gave it to us. We know the retained earnings at the time of acquisition, don't we? From here, we know. Are we together?
Yes, sir.
Right, we know. How much of the pre-acquisition profit or the retained earnings? 3,500. What's the difference?
1,000.
1,000. Right. Then we move on. Do we have any fair value adjustment?
Yes, sir.
So we have fair value adjustment. The date of acquisition. Oh, this thing is disturbing me here. We have fair value adjustment, right? Because we are told that how do we get it? The fair values of the assets and liabilities approximated their carrying amount except a piece of land with a carrying amount of 2,000, which had a value or which had a fair value of 2,500. So how much is, what does that mean? This one means that all the assets were the same except one item. What is that item?
Land.
Land. And you and I, land, do we depreciate land?
No.
But if it were to be any other asset, like machinery, like plants, like a brand, we will have depreciated it. That's what I'm saying, that anytime you see fair valuation adjustment, there must be depreciation. Is that okay? And
Yeah.
let me explain this side also, just in case. Sometimes they can tell you that the parents acquired this subsidiary 2 years ago. So I'm giving you the other scenarios they can answer this question. Are you with me?
Yeah.
They can tell you that the parent acquired Hashi 2 years ago, not in 2023. 2 years ago means that they acquired it in 2020. Is it 2022? No, 2021, 2022. No, 2 years ago. This one, if you are in 2023, if you are in 2023 and it's 2 years ago,
So
that'll be
1st January 2022.
that'll be 2022, because January to December 2022 is 1 year, and then January 2023 to December 2023 is also is also 1 year. So that will be the dates. Are you getting it? So please take note of this one too. Sometimes the examiner can trick you small on that. So if it is acquired 2 years ago, what it means is that you would have to calculate accumulated depreciation for 2 years ago. So for example, this question, we are getting a fair valuation of 500, isn't it?
Yeah.
Because the carrying amount was 2,000 and they have fair value to 2,500. So there's a fair valuation of 500. Immediately we bring this 500, what it will mean is that we have to calculate depreciation. Fortunately for us, this is land, so there's no depreciation. But if it were to be plants and machinery, it were to be any assets, we will have depreciated this one. The examiner will go ahead and give you information about depreciation. All right. Okay. So if it was about, he acquired it 2 years ago too, you find the depreciation and multiplied by depreciation amount multiplied by 2. So that would be the accumulated depreciation you come and subtract. Are we okay?
Yes, sir.
Right. So let me clean this guy. So take note of that trick over there very, very well. So we have 1,000 here. We move on to fair value adjustment. How much is the fair value adjustment? 500. So we have 500 at reporting and 500 at acquisition. And then we don't have any value here. If it were to be, there were to be depreciation, we will have brought the depreciation of that amount. Okay. Then let's move on further. If there's any other item in terms of the net assets, we have the income of Vichy Limited related to dividend received from the investee. This income, this is you see the state financial position, the income statement. Do you see the investment income here?
Yeah.
So the investment income here is talking about 1,000 cedis. Do we have some figures for Hashi and Vichy? No, there's no figure for Hashi. There's no figure for TC. But we see investment income of 1,000, and this is what the examiner is explaining. That let's go to the footnotes. The investment income of Vichy relates to dividend received from the investee entities as follows: 800 and 200. What do we do about this? This is about intra-group transaction. Do you agree? Do you agree that it's an intra-group transaction?
Yes.
What do we do to intragroup transaction? We eliminate them. Do we recognize intragroup transaction? We eliminate it, because as part of the consolidation process, we can't make money. You cannot make money from yourself, from the group. These 1,000 cedis, the group cannot make money from itself. We have to eliminate this when we are consolidating. We have to eliminate it. So as part of your working, you can, once you've spotted this, you can also go and write it anywhere. I've told you that whatever comes into your mind, write it, and then you would get your tick. So as we are even on this guy, number 3, we can go and, we have not finished with this guy, we can go and write that we eliminate the dividend because it is an intragroup transaction. We eliminate it. So you can come as part of your footnote, maybe number 6, intragroup transaction. And then you say that we eliminate the dividend. We eliminate the dividend income made from the group. And how do we eliminate the dividend income? We have recognized 1,000 cedis for the parents, so we have to the investment income here, we have to debit it with 1,000, and then we credit then we credit the group members, that is Hashi and CC declaration, declared and paid dividend, 800, 200, so that we eliminate this 1,000 cedis. Oh, sorry. So this is just a disclosure you have to make, just for ticks, that you take away the 1,000 that is here. The 1,000 that is here, we are not going to consolidate. We are telling the examiner that we will have to eliminate that. Okay, let's move on further. The next one. In 2023, Hashi sold goods to Vichy at a markup of 20%. The goods cost Hashi 1,000 and half remain in inventory at the end of the year. So this one also is an intragroup transaction. What is the sales value? Who is selling to who? That's the first question. Who is selling to who?
Yes, NCI is selling to parents.
Good. So in November, in your exams, note that parents can sell to subsidiary and subsidiary can sell to parents. This is the trick. When the parent sells to the subsidiary, NCI is not affected in terms of the unrealized profits. When the parent sells to the subsidiary, NCI is not affected in terms of the unrealized profits. But when the subsidiary sells to the parent, the NCI is affected. NCI is affected in terms of the unrealized profits. So you have to confirm from the question, who is selling to who? So in our case, she sold goods to Vichy, a markup of 20%. That means that the subsidiary is selling to the parent, correct?
Yes, sir.
Good. And anytime there is intragroup transaction, the examiner will always test you on markup and margin. Markup is profits expressed on sales and on cost. And margin is profits expressed on sales. So the examiner can always test you on markup and margin, and you can convert markup to margin, and you can convert margin to markup depending on the situation. And you know that if you have markup and you are taking it to margin, it is numerator of the markup over denominator of the markup plus numerator of the markup. Anytime you are taking markup to margin, so that you can now use the margin to express it on sales. And then if you have margin and you are taking it to markup, it is a numerator of the markup of the margin over denominator of the margin minus numerator of the margin. So here is plus, here is minus. Take this, right? Because the examiner can always test you on this margin markup. But in this question, I believe it is a straightforward one. We are told that Hashi sold goods to Vichy at a markup of 20%. The goods cost Hashi 1,000. So do we know the cost of the goods? Hello, are we together?
Yeah.
Do we know the cost of the goods?
Yes,
Yeah.
please.
How much is the cost of the goods?
1,000 cedis.
Good, 1,000. But you know that the subsidiary sold to the parent at a markup. Do you agree? What was the markup?
20%.
So can we apply 20% on this, or we have to change this markup to margin?
You have to change to margin.
We have to change markup to margin.
We apply it straight because markup is always on cost.
Absolutely. So you see, a student who would change this one to margin will be Diego, because here we are giving it straight up. If the examiner told you that, Hashi sold goods to the parents at a markup of 20%, but the sales value was 1,200 or 1,600, then you would now have changed this markup to margin. So please, this is an area that students must always take note of, right? So here we apply the markup straight up because we are giving the cost. So what will be the profit elements?
100.
So the unrealized profit or the profit, first of all, let's do the profit element. The profit element will be equal to 20 over 100 times 1,000. And that gives us 100. 100?
Yeah.
20 over 100.
Please, I want to understand this. They said goods cost Hashi 1,000 cedis and 1/2 remain in inventory at the year end.
I'll come to that, please. I'm not yet there. I'll come there. Yeah. I'm just explaining the first point. So the cost of the goods is 1,000. Do you agree?
Yeah.
And the markup was 20%. Do you agree?
Yeah.
So the profit element that the subsidiary made on this sale was how much? 20% of 1,000. That gives us how much?
200. 200.
So if you want to determine the selling price of the goods that the subsidiary sold to the parent, how much is that?
Yes, 1,200.
Good. 1,000 plus 1,200. Plus 200. And that gives us 1,200. What do we do with this 1,200? What do we do with this 1,200, given that it is an intergroup transaction?
You subtract it from Your revenue and your cost of sales.
Cost of sales.
Good. We subtract it from our revenue. So when we are coming to consolidate here, when we are coming to consolidate this revenue and then the cost of sales, there will be an adjustment of 1,200. So immediately you write this, you know this, write it. The examiner will mark for you. So what do we do with this 1,200? We have to eliminate 1,200 from the revenue, and then we have to debit the cost of sales with 1,200. So write it as part of intragroup transaction. So therefore, debit revenue with 1,200 and credit cost of sales with 1,200. So the examiner will mark all this for you. Right. Now, the second part. And 1/2 remain in inventory at the end of the year. You know the meaning of unrealized profit? Unrealized profit is profit that you have not realized. Unrealized profit is profits that you have not realized. And you have not realized because the things that the profit is on, what you mark the profit on, is still in existence. So we can only determine unrealized profits on goods that remains. You can't determine unrealized profits when you have sold the thing. You have sold to me 1,200 and I have sold all to another party. Then you are saying that, oh, there is an unrealized profit. No. Unrealized profit is calculated on the goods that are there. So do we calculate the unrealized profit on 1,000 or the unrealized profit on what? What do we calculate the unrealized profit on based on this question?
We calculate it on the remaining 1/2 of inventory.
So remaining 1/2 of inventory is what?
That's 500.
That's 500. So we are saying that 500 of these goods remained, and that is what we are going to calculate the unrealized profits on. So what will be the unrealized profit on this 500?
So 20 over 100 times 500.
And that gives us how much?
100.
Sorry?
100.
100. What do we do with this 100? Whenever there is an unrealized profit, what are the entries?
So we take unrealized profits. Since the subsidiary is a seller, we deduct it from the reporting period.
Yes. So, okay, move on. Continue.
And then we deduct it from NCI.
Okay.
I don't know if I'm right.
Okay.
When you get to NCI,
yes.
That's
So technically,
20% of.
good. That's 20% of it. So technically, in terms of our income statement, we need to remove this 100 from our closing inventory in our income state of financial position and debit our cost of sales. So that entry, you have to write it. So we will need to, first of all, debit our cost of sales with 100, and we credit our inventory with 100 to remove this 100 cedi that has been included in the closing inventory. So let me explain again. In terms of our consolidation for the income statement, when we are working on the cost of sales, we have to do the cost of sales with 100 cedis and then credit the inventory in terms of our state of financial position in terms of our state of financial position, inventory, credit to 800, remove the unrealized profit element. In terms of the apportionment of this 100, because it is the subsidiary that sold, because it is the subsidiary that sold, the unrealized profits will have impact on the NCI. Are we okay?
Yes, sir.
Are we okay? Right. Okay. So I think that we can now make progress. The next one is about the goodwill, which she undertakes annual impairment. So, yes, boss.
Since you are doing associate and then you are talking about unrealized profit, can
Yeah.
you brief us on when maybe associate is rather selling the goods to the parent or like to the subsidiary or like?
Okay. So in terms of the associates, okay, as for associates, it's not so much a difficulty. You know, the associate, all we do is we determine our cost of investment. And then we add post-acquisition profits. To increase our cost of investment. That is all we do about associates. So anytime the parent has sold to the associates, what it will mean is that the profits, that the value of your investment that you have in that, so you have to eliminate it from there. So for the associates, all we are saying is that we adjust the cost of investment that we have with any profits that we have made. So if, let's say, our cost of investment is 500 and the associate has made a profit of, let's say, 1,000, and our interest here is 30%, we just do 30% of the 1,000, add it to this guy, 300, so that our cost of investment in the associate becomes 800. Now, if the associate sold to you, it means that the profit that the associate has made here now, that profit is included in this amount. So you would have to debit the profits that the associate has made. In terms of the inventory does not affect you because it is sitting with the associates. But when you sold to the associates, the unrealized profit on it also will have to affect your inventory and then your investment that you have in the associates. We'll pick a question and then use it to explain that one. So the point I want to say is that for associates, all we need to do is to determine the cost that we have, the cost that we have made in the associates. Let's add the profit that we made from the associate to it. In terms of the associate selling to the parent and the parent selling to the associate, we look at the impact on the cost of investment that we have here. Are you okay? We will pick a question on it and then explain that in detail. So quickly finish up solving our question because I normally talk too much. We're on the net asset position. Right. So we have the we have the stated capital, we have the retained earnings, we have the revaluation surplus, and then we have the realized profit, right?
Yeah.
The unrealized profit reporting date. How much was that? That was 100.
100.
We don't have that for at acquisition. So we have 500 here. Sorry, 100 here. All right. So let's total them now. What's the total here?
We have at acquisition, we have 24,000.
24,000.
Yeah.
Net reporting?
24,900.
24,900. So post acquisition?
900.
900. All right. So we've done that as a summary. We should be able to determine the goodwill. So that is note number 4, goodwill computation. Goodwill computation. And what goes into goodwill computation? All you know is your cost of investment. How much of the cost of investment?
29,000.
29,000. Then we determine, we adjust it with the net asset acquired. We adjust it with net assets acquired. Now, let me explain this side. You remember that in the footnote, the examiner told you something, that the group has a policy of measuring non-controlling interest as a proportionate share of the net asset of the subsidiary. Have you seen? When I was explaining to you on the syllabus, we together?
Yes, please.
This is very crucial. That is why I want to come back again. Now, in determining your goodwill, when you go in November, there are 2 ways. If the examiner tells you that, you know, your measuring goodwill is 2 ways. We have a proportionate share of assets acquired. That is one. And then we have the equity method. So when you go and the examiner tells you that use proportionate share and you go and use equity method, with Diego. So when we say proportionate share, all we are saying is that find the net assets. You see, the meaning of goodwill, those of you who came to class, the meaning of goodwill is excess of purchase consideration over net assets acquired. That's the meaning. Purchase consideration over net assets acquired. That's the meaning of goodwill. So in accounting or in business, when we say goodwill, how much did you pay against the value of the assets? So if my value is 2,000 and you paid 4,000 for me, you want me, or you want a girl, and the girl's value is 2,000 and you paid 4,000. The meaning is that you have paid more than the value of the girl. Let me use 2,500. So that how much have you paid more of the girl here? 1,500, it not be so. Are we together?
Yes, please.
So the value of something is 2,500 and you paid 4,000. The meaning is that you have paid 1,500. So this 1,500 is excess, is what you call the goodwill. So in determining the goodwill, the most important thing is we are comparing the net assets of the subsidiary against the purchase consideration. Now, this net asset of the subsidiary, it is possible that you may not pay all the value of the net assets. What it means is that there will be some value of the net asset that will reside with the NCI. So in determining goodwill, we have got two methods. One is a proportionate share of the net assets. What it will mean is that if you are using the proportionate share of the net assets, then the examiner wants you to find the net assets of the subsidiary and find the degree of control that you have in the assets. So if you acquired 80% of the net assets, what it means that there is a remaining 20% of the net assets that you didn't acquire. So if the examiner wants you to use the proportionate share, the meaning is that don't concentrate on this guy. Just concentrate on your 80% and compare it with your purchase consideration. That's the meaning of proportionate share of the acquisition. But when you are using the equity method or the full method, then in that case, you have to consider the value of the NCI in your computation. So let me make it clearer here. Assuming, look at this, assuming your consideration, your cash you paid is 5,000, and the value of the net asset is, let's say, the net asset, the value is 3,000, and you acquired 100%. You acquired 100%. What it means is that if you pay this 5,000, because you acquired 100%, this 3,000 is the total value you have acquired. So in this case, you have 2,000 as goodwill. But look here, assuming the same thing, you acquired 80%, you acquired 80%. What if you acquire 80%? 80% of 3,000 is how much? 80% of 3,000.
2,004.
2,400. The meaning is that if you pay 5,000, the value you are acquiring of the subsidiary is 2,400 and not 3,000. You see, when it was 100% and you paid 5,000 and the value was 3,000, you got a goodwill of 2,000. This 2,000 is because you acquired 100%. So the net asset here was 100%. But assuming you are acquiring 80% of this net assets and you do 5,000 minus 3,000, 2,000 is not your goodwill. Because the value of the lady is 2,400 in terms of your 80%. So in this case, if you want to determine goodwill, it is your 5,000 over 80% of 3,000. And when you do this, we call this one the proportionate share. The opposite is that if you want to do the full method, then in that case, the net assets of the subsidiary is going to be the value of NCI, and then the value of the NCI, and then the share of the net assets acquired. That these two will give you the total value so that you can compare it against your cost of investment. So when you do this, this is what we call the full method or the equity method. In this case, the examiner, if the examiner wants you to do this, the examiner can give you, how do you value this NCI? So the examiner can tell you that the value of this NCI is, they are using the fair value method. Please, is it clear?
Yes, sir.
Right. So now that I've explained this, let's go and determine our goodwill. So based on this question, which method are we using to determine our goodwill?
Proportion.
The proportionate share. So what would be the net asset acquired? We have done the net asset at acquisition, right?
Yeah.
What was the value of our net asset at acquisition?
24,000.
Good. So we can now find 80% of net assets at acquisition, which is the 24,000. And how much is that? 80% of 24,000?
19,200.
19.
19,200. So when you less this guy from this guy, what do you get?
4,800.
Are you sure? 20. How did you get 4,800?
Yeah, no. Sorry.
9,800.
9,800. What is the name of this 9,800?
Goodwill.
That's the goodwill.
That is the goodwill. So in the exams, if you went to do a different method, you are going to be marked down. Right. Now, once you got this goodwill, where would this goodwill go? Assuming there's no other information. This goodwill, once you have got this goodwill, where will it go?
Non-current asset.
It must be part of your consolidated statement of financial position. So after getting this, you must get additional tick. So I told you that financial reporting is all about tick. Until when your number we know, where will I get an additional tick again? Then in my mind, in my consolidated statement of financial position, my main could repeat the number we or another tick. Or accounting is all about ticks. But we were told that what is the standard governs goodwill payment? No, is it IAS 36 payment of intangible asset, right? But IAS 36 is for tangible asset, but for goodwill, it is actually how do you call it? We are using the IFRS 3. So goodwill is actually not we don't actually impair goodwill, but we test for impairment. That's the word. We test for impairment. The examiner told you that they tested for impairment, right?
Yeah.
Good. Once you test for impairment, what is the impact of the impairment on the goodwill? Are we together?
Yeah.
What is the impact of the impairment on the goodwill from the question here?
It will reduce.
It reduces it.
1,005 minus.
Good. So it means that in November, when you are going, you do the goodwill. Ask yourself, you got this 9,800, no, I control 9,800, consolidated financial position now. That once you get this goodwill, once you get this goodwill, the next thing you ask yourself is go through the question: do we have impairment? If we have impairment, it's that you have to reduce it by the impairment. If you don't have impairment, then that is fine. Bye-bye. So we test for impairment. So you write impairment. How much is the impairment?
1,500.
That one, don't go and calculate it. The examiner will always give it to you. Once you do this impairment, what value do we get as the goodwill?
8,300.
8,300. And this is where it will go to where? To the financial position. Then I ask again, this impairment you have written here, it has reduced your goodwill. The 1,500 has reduced your goodwill. Your goodwill, it has reduced it. Goodwill is an asset. So if it has reduced it, it means that we credited it. No. Yes, it means that we credited it, right? Goodwill is an asset, and it has reduced it. It means that we credited the goodwill. Do you agree?
Yeah.
Where would the corresponding debit entry go?
You share it for the NCI and then the good retained earnings.
Okay. In terms of our income statement, I'm looking at the impact in terms. When I say debit and credit, give me one account. That is not in terms of sharing. So we debited the
cost of sales.
Exactly. So we debit cost of sales in our we debit cost of sales in our consolidated income statement. So you see why normally when you see the question, like you don't just get up and say, "Oh, so let me add this and this." It is based on this working that you do that affect these numbers. Are we together?
Yes.
Right. So it's either we debit the cost of sales or we can bring a line item as operating. Sometimes it goes to the operating expenses. We can add it to the operating expenses or we can add it to the cost of sales, depending. You can always explain. Sometimes once we have credited the goodwill, we can add it to the cost of sales or we can add it to operating expenses. But I will advise that we add it to the operating expenses. Okay? if the examiner wants you to add it to cost of sales too. No, it's like depreciation. And depreciation is added to your cost of sales or added to your operating expenses. Is that okay?
Okay.
All right. So I think we are done with all these ones. So we can now quickly do the consolidation. But I wanted us to start at 3 o'clock so that I will end at 6. But I have to prepare the kids for school. So we would end the class here, and then we'll continue with the consolidation. What we have done here means that at this point, you'll be able to consolidate because these are the workings that you will fetch you the mark. The rest are just adding this to this because it is not a proportionate share. We are just going to add and adjust the numbers. So I would crave your indulgence to the class here. And then when we meet on Saturday, we are just consolidating and we move on to the other areas. Are we okay, guys?
Okay.
All right. Thank you very much and have a good day.
Yeah, please, will you send the slide?
Yes, admin will do that.
Mm-hmm.